Welcome to the Taxation Chapter 5 video. In Chapter 5, we're going to focus on capital cost allowance, CCA, and also the disposition of depreciable assets. So first of all, what is a depreciable asset? Well, some examples are buildings, equipment, automobile, computers, and furniture. Depreciable assets are anything that basically has a wear and tear factor where the asset will lose value over time. Now, in accounting, we learned that whenever we purchase depreciable assets, we're going to allocate the cost over its estimated useful life, and we take accounting amortization. For tax purposes, we refer to that same amount using the tax rules as capital cost allowance. Now, when it comes to capital cost allowance, we're going to separate all of our depreciable assets into different classes. And each class has a different CCA rate. Once again, this is quite different from what we learned in our accounting classes when we were calculating accounting amortization. Now, in 2018, there was a significant change in how we calculated CCA for tax purposes. For assets that were acquired on November 20th, 2018 and earlier, we have a rule that was in effect called the half-year rule. Now, the half-year rule does still apply in some very limited situations and classes, so make sure that you read your textbook on those limited situations. Now, moving forward, after November 20th, 2018, we have a new rule called the accelerated investment incentive, and that largely replaces the half-year rule. Now, the accelerated investment incentive, once again, is trying to accelerate the amount of CCA that a business is allowed to claim, whereas the half-year rule was trying to limit the amount of CCA a business could claim in the year they acquired depreciable assets. And we'll go through some examples in a couple minutes. Now, one other thing about CCA is that it's a discretionary deduction. What that means is when a business calculates the total maximum amount of CCA that it's able to deduct in a particular year, it can actually deduct anywhere from 0 to the maximum and anything in between. One of the reasons why a company may not want to claim the maximum CCA is if they're already operating in a loss position. By taking the maximum CCA, they could increase the loss, and they may not want to do that. So once again, when it comes to CCA, a business will calculate what the maximum CCA deduction is under the tax rules, and the business can claim any amount from 0 to that maximum. Now, the last point on the slide here is that if a company wanted to take some amount of CCA, but not the maximum, and it was over different classes, a tax planning strategy is to take the CCA from the lowest rate class. Therefore, it would save higher CCA deductions in future years. And once again, this will make a little bit more sense when we start doing some CCA calculations. So let's move on to the next slide, and let's talk about some of these common classes. Now, buildings are assigned to Class 1 if they were acquired after 1987, or Class 3 if they were acquired before 1988. Now, in Class 1, there are different rates. Now, when you read through your textbook, what you'll see is that normally Class 1 is a 4% rate. However, if the building is used more than 90% or more for manufacturing and processing activities, that rate increases to 10%, or if it does not qualify as a manufacturing or processing building, if it's used greater than 90% or greater than for non-residential purposes, that CCA rate goes up to 4%. Moving on, equipment. Equipment that's not listed anywhere else goes to Class 8, and the CCA rate for Class 8 is 20%. Now, manufacturing equipment gets assigned to Class 53 if it was purchased after 2015, and that has a CCA rate of 50%. Some other common classes are automobiles. Automobiles go into Class 10 or Class 10.1 if the cost is greater than 30%. And once again, the CCA rate for Class 10 or 10.1 is 30%. Now, there is a change to automobiles that are considered zero emission vehicles. They either go into class 54 or 55. And once again, your textbook will give you more details about how these different classes operate. Computers, well, hardware and system software goes into class 50, which has a CCA rate of 55%, and application software goes into class 12, which has a rate of 100%. And furniture goes into class 8. Once again, class 8 has a rate of 20%. So this is just some examples of some common classes that business would see when they're acquiring depreciable assets. Moving on to the next slide, let's talk about calculating CCA. Now, most of the classes when we calculate CCA use declining balance, and there are some exceptions, for example, class 13 and 14, which we'll look at a little bit later on. Now, let's look at the rule that was in effect in 2018 and once again prior to November 21st, 2018. That was the half-year rule. Let's say that this company, ABC, acquires furniture and they had no other furniture purchases prior to this purchase on February the 1st, 2018, and they bought the furniture for $20,000. So furniture goes into class 8, which has a CCA rate of 20%. So let's actually look at how the schedule will look like. Class 8 at the beginning of the year, we had 0. So this was the first purchase of furniture, the first asset that was purchased for class 8. So the beginning balance in 2018 was 0. We bought the furniture in 2018. And once again, this was prior to November 21st, so the half-year rule is in effect. And our net additions is $20,000. Net additions refers to all your additions minus your dispositions. In this particular year, ABC just bought equipment, they didn't sell any, so the net addition is $20,000. The way the half-year rule worked was that in the year of new additions, we would only be able to take CCA on one half of those net additions. So we would have to remove half of the net additions, and that's going to leave us with a CCA base of $10,000. Now, the CCA rate for class 8 is 20%, so the maximum CCA we could deduct would be $2,000, 20% of $10,000. However, moving on to the new year, before we actually close off this year, we have to add back that $10,000 that we took off up above, and that would bring us to the balance at the end of the year of $18,000. So that would be the amount that we would begin with in 2019. So that's an example of how the half-year rule worked. And now remember, once again, the half-year rule moving forward is no longer in effect, only in very limited situations. So let's move on to the next slide, and let's look at the same example now using the accelerated investment incentive. Now remember, the accelerated investment incentive largely replaces the half-year rule for acquisitions from November 21st onward. So let's use that same example, but let's say now we're in 2020. ABC buys the furniture on June 23rd, 2020. There's no other assets in the class, and so at the beginning of the year, we have a 0 balance. We now add the $20,000. That's our net additions. Once again, net additions are additions minus dispositions. We have 0 dispositions, so our net additions is $20,000. The way the accelerated investment incentives works is that this is trying to enhance the amount of CCA we can deduct this year. So we get to make an adjustment by adding 1/2 of the net additions. Remember the half-year rule took off 1/2 of the net additions. The accelerated investment incentive adds 1/2 of the net additions. That's going to bring our CCA base to $30,000. We take 20% CCA, which is $6,000. Now, before we close off the year, that $10,000 that we added above, we now have to remove that before we close off the year, and that's going to give us an undepreciated capital cost of $14,000. If you think about it, we bought the furniture for $20,000. We took CCA of 6, and so going into next year, that's going to leave a balance of $14,000. and that's the balance that we have at the bottom of the slide here. So that's how the accelerated investment incentive works. Moving on to the next slide, we're going to just focus on the accelerated investment incentive for the rest of this online lecture unless otherwise noted. Now, a couple of things about the accelerated investment incentive. It's eligible for most depreciable assets acquired and made available for use after November 20th, 2018, and also before 2028. This is just a temporary measure that the government put in. Now, the accelerated investment incentive does not increase the total CCA that's available over the life of the asset. All it does is it enhances the amount, increases the amount that's deductible in that first year. Now, there are some exclusions, as we mentioned earlier. Class 12 is excluded from the accelerated investment incentive adjustment. The half-year rule still applies to Class 12. And once again, your textbook should explain how Class 12 works using the half-year rule, so read that on your own. Now, there are some modifications that are necessary if the CCA class uses straight line amortization CCA calculations rather than declining balance. Most CCA classes use declining balance, but there are some exceptions that use straight line. Now, couple of the exceptions to declining balance, one of them is Class 13. Class 13 uses straight line CCA calculations, and Class 13 relates to leasehold improvements. Now, on the screen here is the calculation for CCA for Class 13, and we'll go through an example on the next slide. The accelerated investment incentive does apply, and we'll demonstrate that on the next slide. Now, another exception to declining balance is Class 14. Class 14 is limited life intangibles, and it also is straight line, but Class 14 is calculated on a pro rata per diem basis. What that means is it's done on a per day basis. The accelerated investment incentive does apply to Class 14, and we'll look at that example in a few minutes. Moving on to the next slide, let's look at Class 13. Class 13 applies to leasehold improvements. Let's look at an example. ABC signed a 10-year lease on some office space, and they were given 2 renewal options of 5 years each. And during the year, they made $300,000 of leasehold improvements to the office space. So leasehold improvements are basically improvements that are done on an asset that the company does not own, rather they lease. So ABC signed a 10-year lease on this office, and they spent $300,000 basically for substantial renovations to the office space. And that $300,000 now gets allocated to Class 13. Now, Class 13 is calculated using straight line, and we said earlier that the maximum deduction is the lesser of 2 amounts. 1/5 of the capital cost, which is $300,000, or the capital cost divided by the lease term plus 1 renewal period. So let's actually look at the first calculation here. 1/5 of $300,000 is $60,000. Now, because of the accelerated investment incentive, we can multiply that by 150% to get $90,000. The second calculation, we take the capital cost, $300,000, divided by the lease term remaining. In this example, we just signed the lease, so there's still the full 10 years remaining, plus 1 renewal option. Even though they're given 2 renewal options, we just add 1, so it's $300,000 divided by 15 years, which is $20,000, multiplied by 150% because of the accelerated investment incentive, and we get $30,000 for the second calculation. So because it's the maximum based on the lesser of these 2 amounts, the lesser is going to be $30,000. So in the current year, this first year, we get to take $30,000 CCA. Now remember, this is straight line. So going forward, we get to take $20,000. Remember, the maximum is the lesser of the 2 amounts, $60,000 and $20,000. So we get to take $20,000 a year, except in that very first year, we get that enhancement because of the accelerated investment incentive. So that's an example of how Class 13 works. Let's move on to the next slide and let's look at Class 14. Class 14 looks at limited life intangibles. So for example, we buy a franchise. A franchise is an intangible, and usually franchises have limited life. We calculate the CCA amount over using straight line over the legal life, and this is also done on a pro rata per diem basis, on a per day basis. Let's look at this example. On April the 1st of the current year, the company buys a franchise for $500,000, which has a legal life of 20 years. It's done on a straight line basis. The CCA per year would be $25,000 per year. Now, in the first year, we have to prorate that based on the number of days. We bought it on April the 1st, so April the 1st to December 31st, that's 275 days over a total of 365 days. And there's a further adjustment for the accelerated investment incentive to enhance it by 150%. So in that very first year, the CCA that ABC could take is $28,253. Now, moving forward, because it's straight line, next year we get to take the $25,000. So that's an example of how Class 14 works. Moving on to the next slide, let's talk about when a company disposes of depreciable assets. Whenever there's a disposition of depreciable assets, the rule is that you have to deduct the lesser of proceeds or costs from the CCA class. Now, if there's a positive balance remaining after this deduction and there are still assets in that CCA class, the company will just continue taking CCA. Now, if there's a positive balance and there's no assets remaining at the end of the year, this is known as a terminal loss, and the company gets to deduct that remaining amount from their income. Now, it could also happen where when they deduct the lesser of proceeds or costs, there's a negative balance, and it remains negative at the end of the year. This is known as recapture. That means the company took too much CCA over the life of the asset, and so they have to basically add that amount back into their income for that year. Now, a capital gain is also possible when there's a disposition of depreciable asset, and that would happen is in a situation where the company sold the asset for more than they bought it for. So let's actually move on to the next slide now and take a look at some examples. Oh, actually, before we do that, there is never going to be a capital loss on the disposition of depreciable asset. And once again, that will become a little bit more clear when we go through these next examples. So let's look at this first example. At the beginning of the year, ABC has a Class 8 undepreciated capital cost balance of $110,000. During the year, they sold the only piece of equipment that was in Class 8 for $80,000. And the original cost of that equipment was $200,000. So essentially, ABC bought this equipment for $200,000. They took CCA over the years, and at the beginning of this year, the undepreciated capital cost is $110,000, and they sold that asset this year for $80,000. So let's set this up. Our CCA schedule look at as what's shown here on the slide. The beginning balance is $110,000. Whenever we sell an asset, we have to deduct the lesser of costs or proceeds. We're going to deduct proceeds, which is the lesser amount for $80,000. That's going to leave a balance of $30,000. Now, we don't have any more assets in this class. We sold the only piece of equipment in this Class 8. Whenever we have a positive balance and there's no assets remaining, this is known as recapture. Let's actually take a look at why. We paid $200,000. We took CCA of $90,000. That means we had that $110,000 left at the beginning of the year. We sold the asset for $80,000. That basically means we're still behind $30,000. And so what this tax rule says is that we get to fully deduct this amount as a terminal loss, and that's going to reset this balance to zero. So that's an example of a terminal loss. Now, let's do another example. We're going to go back to ABC. The balance in Class 8 is $180,000 this time around. And now they're going to sell the only piece of equipment in this Class 8 for $210,000. more than the original cost of $200,000. So let's set up the schedule. Beginning of the year, $180,000 is the undepreciated capital cost. Whenever we sell a depreciable asset, we deduct the lesser of costs or proceeds. In this example now, the lower is going to be the cost of $200,000. We sold the asset for more than what we bought it for. And so we deduct the lesser of costs or proceeds, and that's going to leave us a negative balance of $20,000. That if that balance remains negative at the end of the year, we have what's called recapture. And the reason why is we paid $200,000 for the asset. We took CCA, we took deductions of $20,000, but we basically got all of that back when we sold it. So we have now an income inclusion of $20,000. We have to add that amount back into income and reset this to 0. Now, in addition to that, because we sold the asset for more than we bought it for, we also have a capital gain of which 50% is taxable. So we'd also have to include a taxable capital gain of $5,000 into income. Moving on to the next slide, let's look at a comprehensive example. I'm just going to list the facts here on the slide. We have an opening balance of $180,000 in our Class 8. We sold a piece of equipment from this class for $210,000, but we also bought a new piece of equipment for $250,000. What are the tax consequences and what is the maximum CCA that can be deducted? Now remember, the accelerated investment incentive only applies to net additions. So pause the video now and see if you can figure out what the maximum CCA is. Okay, let's move on to the next slide and look at the solution. Now we started off with 180. We added a new asset for $250, and then we sold an asset. Now, whenever we sell an asset, we deduct the lesser of costs or proceeds. The lesser is going to be cost, and so our net additions is $50,000. Now, remember, the accelerated investment incentive only applies to positive amounts of net additions. So we get to increase this amount by $25,000, which is 50% of our net additions, and we get to take CCA on $255,000 at 20%. Our maximum CCA is $51,000. Now we have to remove that $25,000 that we added above. Remember, that was only an adjustment made for the accelerated investment incentive, and then our balance going into next year is $179,000. Now also don't forget that we have that taxable capital gain. That asset that we sold it for more than the cost, and so we have a taxable capital gain of $5,000 as well. Moving on to the next slide, let's look at another example, comprehensive example number 2. I'm going to list the facts here. This time we have Class 10. Now remember, Class 10 is used for automobiles. At the beginning of the year, our UCC is $20,000, and that is from a Honda vehicle that we bought a number of years ago for $28,000. Now, this is the beginning balance. Now, during the year, we sold a Honda for $19,000, and then we bought a Kia vehicle for $15,000. See if you can determine what the tax consequences are and what the maximum CCA that can be deducted. Now remember, the accelerated investment incentive only applies to net additions. So what that means is that if your net additions are negative, the accelerated investment incentive does not apply. So pause the video now and then resume the video once you've done your calculations. Okay, let's have a look at the solution on the next slide. We started off with $20,000. We added that Kia of $15,000, and we sold a Honda, so we deduct the lesser of costs or proceeds. The lesser is the proceeds of $19,000. That's going to give us a negative amount for net additions. Because it's negative, we do not make any adjustments for the accelerated investment incentive. So we take CCA, we take CCA on the base of $16,000, and our maximum CCA then at 30% is going to be $4,800. We don't have to make any adjustments again for the accelerated investment incentive because we didn't have a positive net additions. So our UCC going into next year is going to be 11,200. Now remember that there's never a capital loss on the disposition of depreciable assets. So that is another good example of how when we have additions and dispositions, we have to figure out that net addition amount first. Moving on to the next slide, let's talk about Class 14.1. Now Class 14.1 is relatively new, and it relates to unlimited life intangibles and goodwill. Now Class, once again, 14.1, relatively new, so let's just talk a little bit about it. It works very similar to other classes. It's based on 5% CCA rate, and it uses the declining balance approach. The accelerated investment incentive also applies. Whenever there's a disposition, you deduct the lesser of costs or proceeds, so that's all the same. If there's a negative balance at the end of the year, we have recapture. Now, one of the biggest differences is that if there's a positive balance at the end of the year and there are no assets remaining, there is no terminal loss. As long as the business continues to operate, they just continue taking 5% CCA on that positive amount. So that's one of the biggest differences with Class 14.1. Moving on to the next slide, some other topics in Chapter 5. There's a section about mandatory versus optional separate classes, and mandatory means that certain situations you have to have separate classes. If you operate two different sole proprietorships, then you've got to separate those assets into different classes. If you have rental properties, if the building is over 50,000, then that building goes into a separate class for CCA purposes. If you have a luxury car, and the CCA rates rules refer to a luxury car over 30,000, then it goes into a separate Class 10.1. I want to just quickly look on the next slide about how Class 10.1 works. Now, let's say this company, this taxpayer, purchases a car for $35,000. The maximum they can add to Class 10.1 is $30,000. The government is trying to discourage businesses from buying expensive cars. So they add $30,000 to Class 10.1. Class 10.1 is 30% CCA rate. Using the accelerated investment incentive, the CCA for the first year is $13,500. Then we move on to the second year, $16,500 times 30%. The maximum CCA for year 2, $4,950. Moving into year 3, the UCC is $11,550. Let's say in year 3, the car was sold for $8,000. There's a rule in Class 10.1 that says that you're not allowed a terminal loss. Rather, in the year that the car is sold, the taxpayer will get deduction equal to 1/2 of the regular CCA. So what would be the regular CCA? $11,550 times 30% times 1/2 of that. In year 3, the taxpayer would get a deduction of $1,733, and that Class 10.1 would just reset to a nil balance. Moving on to the next slide, there are also situations where a company could opt to put assets into separate classes. Now, this is available for non-residential buildings and also certain Class 8 assets. And the reason that's available for certain Class 8 assets, specifically ones that are subject to high rates of technological obsolescence, is that the benefit is if they separate those assets into separate Class 8s, when they sell one of those assets, they would be able to claim the terminal loss. And so once again, these are just some additional topics that are listed in Chapter 5, so make sure you read these additional topics on your own. On our final slide, CCA is a challenging topic. So make sure that you review the concepts that we looked at in this chapter, specifically with respect to asset disposition and when we have recapture or terminal loss or capital gains. And remember that there's never going to be a capital loss on the sale of depreciable assets. So make sure you do as many extra textbook questions for practice, and for my classes, make sure that you do review the entire chapter, as all the material is examinable. So good luck with your studies.